Welcome to the Debit This, Credit That podcast with Wheeler Accountants located in San Jose, California. In this podcast, we discuss how to solve accounting challenges in both your personal life and your business. We take an energetic, tech-savvy approach to solving accounting challenges that steal your focus and your time. Now, on to the show with your tech-savvy accounting experts, Matt Wheeler and Michael Bryant.
Hello and welcome to episode 13, which is Pack Your Bags, State Residency Considerations. At different points of people's lives, they look at maybe making a change, whether they're going to move to a different state or a different location. And what Matt Wheeler is going to talk about today is the things that you need to consider, especially from a tax perspective, if you're thinking about changing your state residency. So Matt, walk us through some of these backgrounds. Like what, why, how, what are the considerations? Let's start from a 30,000-foot view and then let's unpack it.
From the 30,000-foot view, you need to understand some of the basics about how states tax income. There's different types of income or revenue streams. Each state treats it differently and how those are sourced to different states. A lot depends on your state residency, which is your primary state of residence, and which states are you a non-resident in. And then there's considerations in a year where you're moving or transitioning, where you're spending half the year in one state and half the year in a new state. There's some unique situations there where you need to apportion the income and that kind of stuff.
All right.
So go ahead.
Well, let's start from the how do states tax income differently. A lot of people, I'm from Michigan, and so we have a lot of snowbirds who go down to Florida, and there are some things involved with being a Florida resident. So I know that there are some differences with state taxes, but is there a general rule of thumb, or how do you as their accountant figure this stuff out?
General rule of thumb is pretty funny because every state's different. There are actually some basic things that are standard across most states, but it's kind of funny you say that because every state does have its own little quirks and unique things. We live here in California and we have our whole set of unique things. Basically, we have this whole list of stuff that we conform to the Internal Revenue Code on, and then a whole gigantic list of stuff that we don't conform to, and it has a different California treatment. And it's always a big pain in the butt on the California side to try and figure out what adjustments you make between federal and California.
Okay.
Anyway, for the different types of income the states tax, there are some similarities among the states. Generally, there are a few different major types of income, and how they're sourced is pretty standard across the states. Wages or service income, so when you're performing services or doing work, those are generally sourced of the state where the services are performed. For most of us, we go to our job every day, the same place, we live in our state. You don't really think much of this kind of stuff, but if you're a consultant or something, and maybe you travel to different states to go work on client projects, it actually can get very complicated, and you do end up having these state obligations in each state that you go do work in generally. Each state could have a different definition of how long you're working there before you're considered to be having sourced income to that state.
No.
So it gets complicated, right?
Now, is it time? I'm sorry, I'm going to interrupt you. Is it generally a time thing, or is it a monetary amount?
Generally a time thing,
okay.
Although
okay.
Some states do have like economic nexus standards. That's more of a business concept.
Okay.
But usually it's a time thing. There's a dollar threshold sometimes.
Okay.
So wages and services income, where you're doing the work.
Mm-hmm.
Rents are sourced of the state where the property is located. That kind of makes sense. If you got a rental property in Michigan, that's going to be Michigan source income.
Mm-hmm.
If you got a rental property in California, it's going to be California source income. Gains on the sale of tangible property, like stuff you can hold or real property, those are also a source of the state where the property is located. So if you sell a piece of real estate in a certain state like California, even if you don't live in California, that's still California income, and you pay California income tax on that.
Mm-hmm.
Next, we have intangible income. So that would be a lot of your portfolio investment type income, interest, dividends, capital gains on stock. Those are all going to be sourced to your state of residency. So those will be income to wherever you're living, right? Because those items don't have a physical presence anywhere. Your stock in Coca-Cola doesn't live in any one state, so it's sourced to the state where you live when you have dividends on that or gains or whatnot. And that's an important concept we need to think about for later in the podcast, because that's a key consideration when you're going to be moving out of state and selling an intangible asset.
Gotcha. Okay.
And lastly, we have stock options or equity compensation. This basically is under wages and services income, but there are some very unique methods in how we allocate that income. And that's another real big consideration here. But when you're talking about moving out of state, especially for our clients here in Silicon Valley, where equity compensation can be a significant portion of your overall comp, we can apportion that the income based on the state you're living in and where the state you were in when the stock was granted to you. California in particular has some unique rules. The law says you can use, quote, any reasonable method, which is pretty gray. And they only give one example of an actual reasonable method, and that's taking the number of work days in California compared to the number of work days in total, and then multiplying that, by the income over the life of the stock from grant date to generally exercise date if we're talking about options, or vest date if we're talking about restricted stock or something. So, we'll basically apportion based on how much time you spent in California versus how much time you spent out. But there are other ways we can do it. A lot of equity comp grants are based on performance of the company. So let's say you were working for the company and you had a certain number of shares set to vest that you were granted. And by the way, when the shares vest is when you're actually taxed on them. When you're granted the shares, it doesn't mean anything from a tax perspective.
Okay.
So if you were to get shares granted on, June of 2017, and then they're not going to vest until December 2017, if you moved in September or something, California is going to say, well, roughly half of the income from that vest, which is going to happen in December, is attributable to California, right? Because you spent about 3 months still in California when you first got them. Then you spent 3 months in the different state when they actually vested and the taxable income happened. But if there's components of the equity comp, like, they're tied to performance of the company, and you don't know any of that performance until Q4 of the company, or you had like a really good Q4 that kind of brought things back from down in the dumps in Q3 or something, you could say it's a reasonable method to allocate based on when the performance of the company actually happened, and then allocate more of that income to out of the state because you had moved after the stock started doing better, after the company started doing better, rather than the period during which you were a California resident, right? So it gets complicated, gets nuanced, and that's why we have these strategies here to help try and really minimize your tax hit. So those are the types of income. The next thing you need to really consider is, when are you determined to be a resident of a certain state?
Yeah, but this is super easy, right? I mean, we've all heard this. It's 6 months plus a day, right? So if I live in Florida and I'm a snowbird, I need to spend 6 months plus one there, and then I'm considered a resident. I mean, this doesn't sound as complex as everything else you were just talking about.
6 months in a day is a pretty common myth. I mean, it's certainly a consideration. So if you're spending the majority of your year in a place, there's a high likelihood you're a resident there. But there's no black or white test, and it's not the only test. The state doesn't come in and say, okay, well, you are a resident here for 6 months and a day, so that's your full-time resident state, and the other state that you're spending all your time in, that's a non-resident state. It's not that simple, right? They look to many different factors to determine where your state of residency is, and it's based on what's called a facts and circumstances test. So they look at a bunch of different things to determine which state are you actually a resident in. Have you really moved or not, right? And the key is really moving. I got clients all the time that think, yeah, I can spend, 6 months in a day in Tahoe on the Nevada side, and I'll have all my income be Nevada income and not subject to California tax, and I can spend the rest of the half of the year back at my normal place in California. And it doesn't work like that, right? So a better question I like to tell clients is to ask yourself, what would the state look at when they audit your residency? If they're going to do an audit, what are the things they're going to look at? And they're going to look at a bunch of different things. They're going to look at where your driver's license is from, where you're registered to vote, if you go to church, where your church is, doctors, dentists, accountants, lawyers, other professionals, where do you maintain those relationships? Where do you bank? Where's your family located? Or if you have minor children, where are they located? Where's the location of real estate that you own? Do you own a bunch still in California if you're trying to prove Nevada residency, or do you not own anything anymore? Did you sell it all? The time spent in each state obviously is an important one, but not controlling. Where your business ties are, where you do most of your business. If you're still working and you're doing most of your business here in California, there's a strong likelihood they're going to say you're a California resident. And then one of the last things is your primary residence that you were living in before you moved. Have you kept that and just sitting empty and use it half the year? Or have you actually sold that or rented it out or something else that is more indicative of you not having a residency status anymore in California? So the bottom line is not black and white. It's very, very gray, but it's a facts and circumstances test, each kind of thing. And if you get into a residency audit, they're going to look through your gas receipts, your credit card receipts, where are you buying stuff, where were you when you were buying it, how much time you're spending there, and they'll try and prove that you were spending too much time in the state, therefore you're a resident, right? And the dollars can be big. In California, our top rate's 13.3%. So if you're making a few million a year, like a high income taxpayer, that's $133,000 for every $1 million of income. That's not chump change. That's real money.
That is real money.
Yeah. So establishing residency and following the rules is really important. And what I really tell my clients is you really have to move. You can't play games. You can't, maintain a bunch of your connections here, but just kind of move in theory and spend some time out of state, but not really. And all your ties are still here. You really have to have moved for real.
So let's say I'm going to move, right? So I'm like, okay, I'm out. What happens in that year? Does it matter what month I move? Does it matter? Help me with that.
So when you move in the middle of the year, you're going to be considered a part-year resident for each state generally. And the states are going to look at your income for the period during which you were a resident until the date you moved and apply the rules as if you're a resident there. And then they're going to apply the non-resident rules for the second half of the year, second portion of the year when you're no longer a resident. And for the state you move into, they're going to apply the residency rules as soon as you establish that you're a resident of that state. And theoretically, they'd apply the non-resident rules when you're not in that state. So, example is that if you were a California resident until July 1st, then you move to Colorado. While you're a California resident, all your W-2 and wage income is going to be California income. Say you have a California rental, your California rental income is obviously California income. Say you have a brokerage account has some interest and dividends and stock gains, that's all going to be California income up until July 1st. Then on the date you move, your wages are now going to be Colorado income. Your interest and dividends and capital gains in your brokerage account are not going to be Colorado income. But your rental income is going to be California income still, because that's coming from a property in California. And California is applying the non-resident rules to you, where income sourced to the state now is California income.
Okay.
But as a non-resident, things that aren't sourced there, like wages, interest, dividends, capital gains, those aren't California income anymore. So you're basically a dual resident that year, more or less, for a portion of the year in each state. So we allocate the income. We try and do it by exact date, especially if you have like gains in your stock account or something. We'll go look and see if the gains happened before or after the date of move, because that can make a big difference on your state tax. Some things will just apportion by the period of time you were in and out of the state. If it's too complicated to do otherwise, like interest and dividends, maybe we got to look at what's a reasonable method on how to do it and how much time do we want to put into it, how material is it, right? So we'll kind of look through all that, but basically you're going to be a resident during different periods for different states.
Okay. So here's my favorite thing about you doing these podcasts is you're going to give people some really good tips here. So let's talk about, so I'm making that consideration. I'm about to make a move. You have 5 state residency tips here. So let's break down each of these 5 and give our listeners some really good meat to chew on.
Sure. So we got 5 different tips, and state tax is becoming such a big component overall. I don't think we really talked about that part yet, but it's becoming an ever increasing part of the pie of your total tax spend each year. And so it should be a significant part of your overall tax plan as the state income tax considerations. I just saw something that said Massachusetts was considering a millionaire tax, 4% tax on income over $1 million in Massachusetts.
Wow.
So I think their rate's like 5% right now, 5.1. So we go to 9.1 for all the income over $1 million. California has a similar one, but it's 1% on tax over $1 million. So you're seeing some of these things, and they can make a big difference. Like Massachusetts one, that's a 4% additional if you're, you know, a Massachusetts resident and you're making a couple $1,000,000 a year and you leave to a no income tax state, that's going to be 90 something thousand a year state income tax.
Sure.
California, 133,000 for each million of income. So these are big numbers. And that kind of brings us to tip number one is if you're going to have a liquidity event coming up, like you're anticipating selling your company or something like that, and you own stock in the company, plan your move well in advance of the liquidity event. Because if you recall the sourcing rules we talked about a few minutes ago, intangible income, like gains from the sale of stock, that's sourced of the state where you're a resident. So if you are a resident of a no income tax state like Nevada or Washington or Florida or some of the no income tax states, during when you sell your company stock, you're going to get that state income tax free. So if you're going to have a multi-million-dollar exit, you can save yourself hundreds of thousands of dollars by properly planning a move. And I know moving's a pain and people hate moving and all of that, but a couple $100,000 can make it a little easier. You can pay a lot of movers to help move your stuff, and you can find a nice house somewhere else, right? Mm-hmm. So you really need to move for real, and you have to start that before you begin any sort of negotiations or signing a contract on a sale. If you start talking about selling your business and you enter in negotiations with somebody, and then you kind of ink the deal and then move out the next month and the deal closes the month after that, California is going to be all over you, right? So they're not stupid, and you clearly ink that deal when you're still a resident in California. They're going to argue that entire thing as California gain. And it makes sense. I mean, you built the whole company there. The value of the company increased the entire time you were a resident. California wants its share, right? But if you can move at least a year or a year plus out, especially where it's not like a tax year right next to the one that you're selling in, then you're further removed from that argument, and it becomes less of an issue, especially on the audit. If you've really moved and you've been a resident of a new state for a couple of years or something, then you're not going to have much of a problem there when you sell your company. It's going to be pretty clear you're a resident of the new state, and nothing's going to be allocated back to the state you left. I use California here a lot because that's what we're talking about where we live here, but. And
that makes a lot of sense. I'm glad that you're bringing that up, because I'm sure there are a lot of business owners who are listening to these podcasts and making those considerations, especially from a tax planning standpoint or a business succession standpoint. I just want all of our listeners to understand that you do need to sit down with your accountant, because what Matt's showing here and really opening up some eyes and some doors to some knowledge, this is really, really important stuff, which leads us to the second one, which I know a lot of people fail miserably at, but it's very, very important. Is that correct?
Exactly. Have to maintain contemporaneous records, have to keep detailed records, and document. Because if you get in a situation where you're going to have an audit on this, you want all your ducks in a row. Our last podcast was about this. It's about preparing yourself for an audit when the IRS calls. Having documentation is the key to getting through that successfully. And the same thing's going to apply if you enter into a residency type audit. California or some states are going to be really aggressive because they're going after that revenue. So you need to have all the documents lined up. Where you are working, your calendar, how many work days in California versus outside of California, that kind of thing. You want to be prepared so that you can have good records in case they do come looking, right? We had a client this last year. He was actually, a California resident for several years, but in his position in his company, he was traveling all over the country and the world constantly. Like he'd maybe spend 60 days a year actually in his house in California because he was traveling constantly, international, across the country, whatever. And so we had the discussion, I said, Todd, why don't you just think about moving your state of residency to Nevada or somewhere else? You're barely home anyway, and you're paying California tax on all of this income. It doesn't make a lot of sense, right? You spend some time in California, but not a ton. And he thought about it, and he's like, you're right. It wouldn't make that big of an impact to me in my life, and this is going to be significant dollars. So he went back through, made a log calendar of where he's been living and where he's been working constantly. He made the move. Then we use that log to apportion some of his income back to California, because there definitely was some that was California. There was a big stock component to his transaction also. So, we had to allocate some of that to California. But by and large, a good 70-80% of his income then was outside the state of California.
Mm-hmm.
And then, fortunately for him, there was a liquidity event last year, a few $1,000,000. We only had to allocate a small portion of that to California because a lot of it was a change in control type payment, which we didn't have to allocate to prior periods. It was all a bright line date as of the date that happened, when he was clearly a resident of a different state. So we were able to save hundreds of thousands of dollars in state income tax for him by just, planning properly and making sure he's keeping good records and having that conversation. Do you want to stay in the state or not?
Mm-hmm. We might want to jump in, Matt, not today, but just on another podcast, talking about international aspects of this too. So we're talking about state today. What happens, and again, I'm just planting a seed for later down the road. What happens if I spend an enormous amount of time in let's say, Mexico or France or Spain? So I'd like you to think about that, because I think that could be a neat follow-up to this one, because I like how you just went back and said, maintaining really, really good records is so important, not just for the state residency tips here, but also from our last podcast, which was all about, when the IRS comes a-knocking. So the 5 state residency tips number 3 has to do with real estate. So break that down for us.
Yeah, number 3 is if you still own real property in your state of residency that you're leaving, we usually recommend selling it early or renting it out, and then you can do some sort of tax-free 1031 exchange later on to defer the state gain. Real property gains, remember, those are sourced of the state of residency. So if you have a significant gain built up in your primary residence, you're not going to get out of the state income tax on that. But there's things when you leave the state, or when you sell your residence, you get that $250,000 or $500,000 exclusion from income if you lived there more than 2 years and it's been your primary residence, and yada, yada, yada. So that can be a significant tax cut from the gain. You may end up not paying that much state income tax or tax in general if you just sell right away. The longer you wait after you move out and you maintain that residence, you start to have that clock going on that living there last 2 out of 5 years. And if you haven't lived there in 2 of the last 5 years because you've been gone for a few years, now you're going to lose that potentially $500,000 tax-free gain if you're married, or $250,000 if you're single. So if you're moving for real and you're going to move, we just recommend selling right away if you can, if the tax hit isn't too bad. That way you're making sure that you kind of got your ducks in a row. You don't own property in the state anymore. You don't have much ties to the state you're leaving anymore. That way you're more likely to win under an audit or be able to prove that you really did change residency.
Mm-hmm.
And if you really don't want to sell the property, say you want to keep it and maybe you're interested in moving back at some point, that's fine. But then you should rent it out or something. That way at least you're not having this empty or vacant home that you could potentially be returning to. That's going to make the state suspect, right? If you have this home that you left that kind of sits there, they don't know if you're really actually using it all the time or not. They're going to go then look at all your gas records, that kind of stuff, like we talked about, right?
Mm-hmm.
But you should either rent it out or sell it. That way you're making it crystal clear, hey, I've moved. I don't live here anymore. Therefore, I'm not a resident anymore.
Sure.
And if you rent it out, what you can do is at a later date, within a year or two, you could sell it and do a tax-free exchange into a new rental property or investment property. And that way you at least defer the gain, and you're not going to pay tax in the gain, and you can get a new property in a new location, treat it as a rental or investment property for a little while, and then maybe eventually you move into that property. Now you've transferred your residence to a new state, basically, and punted on paying the gain on the tax.
Got it.
California's added some stuff recently where you have to disclose on a special California form, if you do a 1031 exchange, how much of the deferred gain is California source, and you got to keep filing that indefinitely, so they don't want to lose track of that kind of stuff. They kind of onto it a little bit. You can't let it just fall by the wayside and forget after you do 1031 out of the state, stop filing California and never pay tax on the gain. They want their share. So you got to file that form, but at least you can defer it so you're not paying a big tax hit when you do leave, if you do have a significant gain in the house, right? So for that third residency tip, real property, sell or do 1031 exchange so you can get out of the state.
Now I'm working in the state still. Let's talk about how that's going to impact what you're talking about and how this is one of the state residency tips.
Yeah, number four, if you're still performing work in the state or you have some sort of connection or you have income that probably should be sourced there, like it was stock or something that you were granted when you lived here and then you left, you really should continue to file in that state just as a non-resident and continue to pay your share of tax that's sourced there. It's the old adage, pigs get greedy, hogs get slaughtered, right? You don't want to just completely cut off from filing in California to now not filing and all of a sudden having no income in the state. That's going to look suspicious. It's not going to look good. And the California Franchise Tax Board may end up deciding to audit you and allocate some income back. So we had a client that did do that. They moved out of state, didn't have any state income tax to California anymore, and the IRS came in to audit. Sorry, not the IRS. The Franchise Tax Board came in to audit California. Lo and behold, he had some stock grants that were originally granted while he was in California. Then they vested when he was out of the state. Same thing with some options that he exercised when he was out of the state. So he had to go back and source some of that income back to California. Now, he had moved to a state that also had income tax, so it wasn't quite the huge disparity. Because you actually get a credit in a different state, typically, for state tax paid to your prior state or another state. So you don't really get double taxed on state income, but there can be a tax rate differential, right? And you're going to end up paying the higher of the two wherever you have the income sourced to. So if you're performing work somewhere, you still got to source some income there. And another benefit there is you're starting the statute of limitations when you do file. So they only have 4 years in California to go back and try and audit you on that. If you don't file on the state, once you leave, that statute's open and they can come back at a later date and try and source income back to California because you never filed. So filing and staying honest will help minimize your trouble if you do a move and you do have some significant income after the move. You want to just keep filing just to make sure, as long as you have income that's actually sourced there,
okay,
to make sure you're kind of keeping that statute limited and you're limiting your overall exposure.
Well, which is interesting because number 5 talks about making sure you don't forget to stop paying some of your taxes. So you're talking about making sure that you are paying taxes in the state if there is income source there, or even if there's before a 1031 exchange or real estate. But now we're talking about some people have to remember that they don't need to pay. So talk about that.
Yeah, the fifth one is that once you move to a new state, if it's a state that has state income tax, you're going to start owing tax in that state. And some people don't really think about it until they go to file the next year's return. And now they're owing a big balance of that state and they're late and they have interest and penalties. A lot of the states don't give you one of the prior year exceptions where you can not pay penalties because you had zero tax in that state the year before. That only applies if you were a full-time 12-month resident or whatnot. So you need to make sure you're taking into account the state you're moving into and you start paying quarterly taxes or you have proper withholding on your wages or whatever in the new state, so you don't have any nasty surprises there, right? So the fifth tip is just making sure you're taking into account all your new state income tax considerations in the new state, if there are any.
Okay.
That way you're not going to be, in a bind later on. And another thing to that is when you do leave the state, a lot of times, say you have W-2 income and part of it is related to stock or something where it should be sourced back to the state you left, the payroll company and usually your company is not going to be withholding the proper amount of tax to the prior state at all. So you got to make those calculations yourself and you got to make those payments yourself. Otherwise, you're going to be caught in a situation where you haven't paid enough tax in and you're going to be facing penalties and interest. So just because your payroll company at work codes it to your new state, everything, and stops coding to the other state or something, doesn't mean you don't have the obligation there. They don't know all the facts. They just kind of do what they're told. So onus is on you, especially when it gets more complicated with stock or some of that other kind of stuff, to make sure you're reporting in the proper states.
Gotcha. So what does success look like? Let's start from before this happens to when it ends. And so the move happens or whatever. Walk us through some of those things that would make people realize, hey, I did this right.
I think if you looked back and could show that you had significant amounts of income or gain that ended up being taxed at a lower state rate or no state income tax, and you'd saved tens or hundreds of thousands of dollars in state income tax, I'd call that a successful outcome for your overall tax strategy with the state income tax component. So really it's just taking a look at the broader view. And we talk about this all the time. taxes are not like a once a year, single year thing. They're a multi-year lifetime thing, basically, right? Death and taxes. So you got to look at your overall tax picture over the period of your life or your working years or whatever, and were you able to significantly reduce your income taxes owed to states by executing a proper move out of state before any sort of major liquidity event or in advance of retirement or whatever, to really preserve more wealth for yourself and have a higher net worth. So I would call that success.
Fantastic. And one of the things you said in a previous podcast is all of this really starts with a tax plan. Can you talk a little bit about that and how you guys do that at Wheeler Accounting?
Yeah, everything starts with a tax plan. You can go to a bunch of CPAs and have someone fill out the forms for you. TurboTax does a pretty good job of it if you give them the right information. What we're doing is we're developing a tax strategy for each of our clients so that we can then execute on it. And we're going to look through a lot of various steps. We have a checklist we can go through and make sure we're tackling, retirement funding, state income tax considerations, sources of income in retirement versus working years, planning for liquidity events, charitable giving, kids and education, tax credits, all that kind of stuff. We go through and look at each one and make sure we have a solid plan in place, that we're minimizing your overall tax liability over the years. So again, your net worth can be as high as possible over the long term, because taxes can be such a huge drag, literally, on your net worth and your earning potential. It's really important that you try and do things in a tax efficient manner. So as tax efficient as possible.
Fantastic.
And that's what we do. And we do it a long-term plan. It's a multi-year plan.
Well, Matt, thank you so much for taking some time today and talking to us about what you need to consider when you are going to move, or if you're thinking about moving. Any final thoughts, any closing statements?
If you're expecting high levels of income or any sort of liquidity event, or if you live in a high income tax state, contact Wheeler Accountants today, and we can get to work on a long-term tax, state residency plan for you, so that we can really minimize that. So go to our website. There's an Ask Wheeler section. Click on that. Send us a note. If you're already a client, email your CPA or your accountant, and we'll start talking about some of these things and put it into your long-term plan.
Wonderful. Well, thanks for your time today, Matt.
All right. Thank you, Matt.